All right, stop scrolling for a second, because something big is happening in silver right now. We just watched silver rip almost 25% in a matter of days, bouncing hard from the $71 lows to roughly $90 in Western markets, while at the exact same time, Shanghai spot is trading near $104. That's a $14 to $15 premium, about 16%. And that gap doesn't just happen randomly. It's flashing stress in the physical market. The forced liquidation from last week's CME margin hikes, that phase looks like it's fading fast. Buyers are back, shorts are exposed, and price discovery is accelerating. Stay with me because I'm going to show you what's driving this move, how to spot it early next time, and why $100 by Friday isn't as crazy as it sounds. Before I explain what caused this surge, let me teach you something most people miss when markets get chaotic. Price isn't just emotion, it's plumbing. Silver trades in multiple venues at once, and when those venues disconnect, that's information. Think of it like water pressure in a pipe. You don't see the pressure directly, but when one section starts bulging, you know something's backing up. That Shanghai premium is that bulge. It's telling you physical demand is overwhelming paper supply. And here's the thing, when physical buyers are willing to pay up, futures prices don't get to ignore that forever. They eventually get dragged higher, whether traders like it or not. Now, when you see markets operating in different venues, they're supposed to stay connected through arbitrage. That's the fancy term, but really it's simple. If silver's trading at $90 in New York and $104 in Shanghai, someone should be buying in New York and selling in Shanghai until that gap closes. That's how markets stay efficient. But when that gap stays wide, when it persists for days instead of minutes, that tells you something's broken in the flow. Either physical metal can't move fast enough, or nobody wants to take the risk of shipping it, or the physical supply just isn't there to close the gap. Any way you slice it, a sustained premium like this is a stress signal. It's the market screaming that paper contracts and physical metal aren't dancing together anymore. So, what does that tell us? It tells us that the futures market, where most of the price discovery happens, where the leverage lives, where the algorithms trade millions of contracts, that market is disconnected from the physical reality of actual metal changing hands. And history shows us over and over again, when paper and physical divorce like this, paper eventually has to catch up. It doesn't happen on your timeline. It doesn't happen smoothly, but it happens. If this is making sense, drop a comment below and let me know where you're watching from. Because understanding this concept alone puts you ahead of 90% of people trading silver right now. Now here's what's actually happening under the hood. Let me break down the sequence, because this is where the move gets real. First, CME hikes margins. That's the exchange where silver futures trade in the US. And when they raise margin requirements, they're basically saying you need more cash in your account to hold the same position. Sounds boring, right? But here's what it does. It forces leverage longs to liquidate fast. Not because they're wrong about silver, not because they don't believe in the trade, but because they literally can't post the collateral. They're getting margin calls at 2 in the morning, and they've got hours, not days, to come up with cash, or their broker closes their positions for them. That's how you get a waterfall from the mid-80s straight down to $71. It's mechanical selling. It's forced. It's not based on fundamentals changing. It's based on plumbing. Then something predictable happens. Shorts pile in, emboldened by the crash. They see silver dropping 15% in a day, and they think the trend is broken. They think this is the top. Volatility spikes. VIX for silver goes through the roof. Everyone thinks the party's over. But here's what's wild. Physical buyers don't care about your margin call. They see cheaper metal, and they step in hard, especially in Asia. That's why Shanghai never followed the crash. It stayed bid. While futures were getting slaughtered, physical buyers in China were looking at $71 silver and thinking that's a gift. They're not trading on margin. They're not getting liquidated. They're buying actual metal for actual use, whether that's industrial demand, jewelry, or investment. And they kept buying. So when futures selling exhausts itself, and it always does because forced sellers eventually run out of positions to close, you're left with a very specific setup. You've got lighter leverage in the futures market because all those weak hands just got shaken out. You've got aggressive physical demand showing up in the Shanghai premium, and you've got shorts who piled in during the crash now leaning the wrong way. That's the squeeze setup. Rising futures prices start chasing a market where real metal is already scarce. Volume expands because now you've got short covering mixed with new buyers. Algorithms flip from sell programs to buy programs. Momentum funds wake up and realize they're underweight. And suddenly $90 isn't resistance anymore. It's a test of support. Now let me show you what most people are missing. If Shanghai stays above $100 while futures push through $95, the arbitrage pressure alone can shove Western prices higher very fast. Think about it. If you're a market maker or a large trading firm and you can buy silver futures at $95 and simultaneously lock in a sale in Shanghai at $104, that's a $9 spread. Even after shipping costs, insurance, financing, you're looking at maybe a $5 or $6 profit per ounce. That's massive. So what happens? Firms start buying futures aggressively to lock in that ARB. That buying pushes futures higher. As futures rise, the Shanghai premium might narrow a bit. But if physical demand in Asia stays strong, Shanghai holds its ground. The result? Futures get pulled higher and higher, chasing a physical market that won't come down to meet them. That's how you get violent, multi-day moves that feel impossible until they're already over. It's not magic. It's not manipulation in the sense people usually mean. It's just structural pressure resolving itself. The paper market was too low relative to physical reality, and now it's correcting. But here's the part that should make you pay attention. This correction doesn't happen in a straight line. It happens in bursts. You get days where silver moves 5, 6, 7%, because all that pent-up pressure releases at once. Stops get triggered. Momentum builds on itself. And before you know it, the price you thought was crazy high yesterday is now the floor today. This isn't speculation. It's the same playbook we've seen before. Let me give you some context, because pattern recognition is everything in markets. In 2011, silver flushed leverage in a spectacular way. We were riding high in the 40s, and then suddenly the CME hiked margins 5 times in 8 days. 5 times. Silver got absolutely crushed, dropping from near $50 down to the low 30s in a matter of weeks. Everyone thought it was over. The silver bulls were done. But what happened next? Physical demand stayed strong. The paper market had flushed out all the weak hands. And once the selling pressure vanished, silver didn't just recover. It exploded higher. It went from the low 30s back into the 40s in a matter of days. Same pattern we're seeing today. Forced selling creates distortion. Distortion creates opportunity. And when that distortion resolves, price overshoots. Or think about March 2020 during the liquidity crash. Everything was selling off. Stocks, bonds, commodities, didn't matter. Silver got crushed to absurd levels, down to like $12 an ounce at one point. But physical premiums went through the roof. You couldn't buy physical silver anywhere near spot price. Dealers were charging $5, $6, $7 premiums over spot because they couldn't get inventory. The paper market was saying silver's worth $12. But if you actually wanted to buy a coin or a bar, you were paying $18 or $19. That disconnect couldn't last, and it didn't. Silver ripped higher, far faster than anyone expected. Once physical demand reasserted itself in the pricing mechanism, it went from $12 to nearly $30 in less than 5 months. Zoom out and you see the pattern every time. Markets don't move in vacuum. They move in cycles of pressure and release. When you get forced liquidation, whether from margin hikes or broader market panic, you create artificial selling that pushes price away from fundamental value. That creates distortion. That distortion shows up in things like physical premiums widening or delivery queues getting longer or inventory dropping in warehouses. And when that distortion gets big enough, the market corrects violently. Not a little, a lot. Because all the players who were positioned for continued weakness suddenly have to flip. Shorts cover, momentum funds reverse. And you get moves that feel irrational, but are actually just the market catching up to reality. The larger story is that silver doesn't move politely when these conditions line up. It gaps, it lunges, it shocks people who thought they had time to get in. And that's by design, in a sense. Markets are designed to frustrate the maximum number of participants. They chop you out at the bottom. They scare you away right before the move. They make you chase at the top. Understanding that psychology, understanding that structure, that's what separates people who catch these moves from people who watch them happen and wish they had acted. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this fail? Of course. If futures stall below $95, if we get a strong rejection there with heavy volume and futures can't push through, this move could lose steam. If Shanghai premiums collapse back towards single digits, if that physical demand that's supporting this whole structure suddenly disappears, the rally could fizzle. Or if another margin hike hits unexpectedly. If the CME decides that volatility is still too high and they raise margins again, we could see another flush. Those are all real risks. And yes, silver is manipulated. Let's just say it. That's not controversial if you've been watching these markets for any length of time. The question isn't whether manipulation exists. The question is whether you can profit despite it or because of it. And here's the thing about manipulation. It shows up in structure. You don't fight it with opinions. You don't win by posting angry comments about how the banks are rigging everything. You watch spreads. You watch volume. You watch price response at key levels. You focus on what you can measure, not what you can argue about in comment sections. Could this whole thing be a setup to trap longs before another leg down? Maybe. Could it be that the big players are letting silver run so they can unload massive short positions at higher levels? Possibly. Could there be another shoe to drop that we're not seeing yet? Sure. But here's what I want you to understand. It doesn't actually matter whether some shadowy group is pulling strings behind the curtain. The mechanics are what matter. The structure is what matters. You can't control who's on the other side of your trade. You can't control the motives of central banks or bullion banks or whoever else you think is involved. What you can control is your interpretation of the data in front of you. Are physical premiums real? Yes, you can verify that. Is volume expanding? Yes, you can check that. Is price responding to support levels? Yes, you can observe that. Focus on what you can control. There are probably 3 types of people watching this right now. The first type is already in silver and feeling whiplash. You bought somewhere in the 80s, maybe you held through the crash to 71, maybe you added more down there, and now you're watching this rocket back up and you don't know what to do. If that's you, here's what I want you to hear. Your job isn't prediction. Your job is observation. Watch $90. Does it hold as support? Does price dip back down there and bounce? Does volume confirm that level, or does it break down? If 90 holds, the market is telling you something. It's telling you that the flush is over and the new range is higher. That doesn't mean you hold forever. That doesn't mean you ignore risk management, but it does mean the character of the market has changed. You're not in a falling knife anymore. You're potentially in an early stage uptrend. The second type is sidelined and afraid of chasing. You watched the whole thing happen. You saw the crash. You wanted to buy at 71, but you hesitated. Now it's at 90 and you're kicking yourself, but you're also terrified of buying at what might be a local top. That's fair. That's human nature. Parabolic moves punish impatience. If you chase blindly here, you might buy at 92 and watch it pull back to 85 and feel stupid. So, what's the lesson? The lesson is learning to recognize these setups earlier. Forced liquidation plus persistent physical premiums, that's your tell. When you see margins hiked and price crashes but physical indicators stay strong, that's when you start building a watch list. That's when you start getting ready. You don't have to catch the exact bottom, but you can catch the middle of the move if you understand the structure. For you, this episode is a learning experience. Study what happened, internalize the pattern, because it'll happen again. The third type thinks this is insane and destined to crash. You think anyone buying silver here is out of their mind. You think this is a bubble, a mania, whatever you want to call it. And I get it. These moves feel irrational. They feel disconnected from anything fundamental. But markets don't move on comfort. They move on positioning. They move on flows. If there are more buyers than sellers, price goes up, even if you think it's crazy. If shorts are trapped and have to cover, price goes up, even if you think it shouldn't. Your job, if you're in this camp, is to keep watching without letting your bias blind you. Maybe you're right and this crashes. Great, you'll have been proven correct. But if it doesn't, if silver goes to 110 or 120, you don't want to be stuck in disbelief while a major move happens. Stay open to being wrong. No matter which camp you're in, the universal principle is the same. Structure first, emotion second. You can feel however you want about silver, but don't let that feeling override what the market is actually doing. The market doesn't care about your opinions. It cares about supply and demand, about positioning, about mechanical flows. Respect that. So, here's what I want you to answer in the comments. Which type are you? Are you holding and trying to manage this whipsaw? Are you sidelined and trying to learn? Or are you skeptical and watching to see if this breaks? I'm genuinely curious because understanding where you're at mentally is half the battle in trading. So, here's where I stand. I'm not calling a top, and I'm not pounding the table blindly either. I'm tracking signals. Let me tell you what I'm personally watching. First, I'm watching whether $90 acts like a floor, not a ceiling. If price dips back to 90 and bounces cleanly with decent volume, that's a major tell. It means the market has accepted a new range. If it slices through 90 on heavy volume and heads back toward the low 80s, that's a different story. That would suggest the rally was just a short covering bounce and the downtrend is still intact. But right now, the price action suggests 90 is trying to become support. Second, I'm watching for a clean momentum trigger through $95 with expanding futures volume. If silver pushes through 95 and holds it, not just spikes above and falls back, but actually consolidates above 95 for a day or two, that's when this gets really interesting. Because 95 to 100 is no man's land. There's not a lot of resistance there if the move has real momentum behind it. You could see silver gap from 97 to 103 in a single session if the conditions are right. But it needs that clean break through 95 first. I need to see volume confirming the move, not just some low volume melt up that gets sold into immediately. Third, I'm monitoring that Shanghai price like a hawk. If it stays north of $100, if that physical premium holds or even widens, the magnet effect is real. Futures will get dragged higher whether they want to go or not. But if Shanghai starts to crack, if that premium narrows back to single digits, if physical buyers step away, the whole thesis weakens. So I'm checking Shanghai pricing every day, comparing it to spot, watching how that spread behaves. It's one of the most important tells we have right now for whether this move is real or just a head fake. Based on my analysis, this sell-off from the 80s to 71 wasn't random. It was mechanical. It was driven by margin hikes forcing liquidation. That's structural, not fundamental. The rebound so far is validating, not emotional. It's being driven by short covering and renewed buying in a market that got too light on inventory. The fundamental picture hasn't changed. Silver's still in a structural deficit. Industrial demand is still strong. Green energy, solar panels, EVs, all that stuff still needs silver. Central banks are still buying gold, which creates spillover demand into silver. The macro backdrop, whether you want to call it inflation concerns or currency debasement or whatever, that's still intact. None of that changed during the crash to 71. All that change was leverage and positioning. If history rhymes and silver holds 90 as support while Shanghai stays firm, the move that follows could be bigger than most people expect. Not because I'm saying it will, but because that's what the structure suggests. These aren't gradual, orderly markets when they're in this kind of setup. They're explosive. They catch people off guard. I've seen it happen too many times to dismiss the possibility. But I'm also not betting the farm on it. I'm watching, I'm tracking, I'm staying flexible. Because markets can always do something unexpected. I'm not a financial advisor. This is not financial advice. Everything I've shared here is my interpretation of market structure and historical patterns. You need to do your own research. You need to understand your own risk tolerance. You need to make your own decisions based on your own situation. Don't just take my word for anything. Verify it. Check the data yourself. Look at Shanghai pricing. Look at futures volume. Look at inventory levels. Build your own conviction or don't take the trade. That's how you survive in these markets long term. If you made it this far, you're the kind of person who actually wants to understand markets, not just get hot tips. That mentality will serve you well. Most people won't sit through a 45-minute breakdown of market structure. They want someone to tell them buy or sell, and that's it. But you're here because you want to learn how to read these setups yourself. You want to develop your own edge. That's exactly the right approach. Keep doing that. Keep questioning. Keep learning. Keep verifying. If this breakdown helped you see something you missed before, do me a favor and share this video with someone who's trying to make sense of what's happening in silver right now. Hit that subscribe button if you want more content like this, where we break down market structure instead of just throwing out price predictions. And drop a comment below. Tell me what you're watching. Tell me what you think happens next. Tell me if I'm missing something. I read every comment, and honestly, Some of the best insights come from the community in the comments section. $100 by Friday isn't a call. It's a possibility based on structure. Watch the signals, think critically, verify the data, make your own decisions. Stay sharp out there.